All right, let's get right into it. Starting in 2025, there's a really strange and, frankly, dangerous paradox hitting the US tax code when it comes to gambling. On the surface, it looks like the government is relaxing some reporting rules, which, sounds like a good thing. But at the exact same time, they've made the actual tax you could owe way, way harsher. It's a hidden trap, and it's one that could catch a lot of people completely by surprise. So, to really understand how to navigate this whole thing, we're going to break it down into 6 key parts. We'll kick things off with the paradox itself, then we'll decode the specific tax forms involved. After that, we'll dive into the new law that's causing all this trouble, and then, this is the important part, we'll learn the exact method to defend against it. We'll also cover the absolutely crucial record keeping you'll need, and finally, we'll look at the new audit risks that are popping up because of this. Okay, so let's jump into the central problem here. The source material for this calls it a compliance gap, which is just a perfect way to describe it. What we've got is a situation where the tax system is giving you a little bit of a break with one hand, but then it's taking a much, much bigger piece with the other. Now, here is where this whole thing gets really dangerous. On one side, we have what looks like good news, right? The reporting requirement for Form 1099-K is being relaxed. Fewer casual gamblers are even going to get a tax form in the mail. But, and this is a huge but, the bad news is that a new law, nicknamed OBBA, has totally changed the rules for deducting your losses. Under Internal Revenue Code Section 165D, you can now only deduct 90% of your winnings. So think about that for a second. Fewer people are going to get that warning shot, that tax form, right at the exact moment the penalty for getting it wrong has become so much worse. That's the trap. To really see how this trap works, you have to understand Form 1099-K. The way this form is fundamentally designed is a huge part of the problem for anyone who gambles. So here's the core issue, and it comes down to IRC Section 6050W. The law says that Form 1099-K has to report the gross amount you cash out. It doesn't care about the difference between your actual profit, the money you put in to begin with, or all that churn, the constant betting and rebetting. The result is a number that can be wildly misleading and make it look like you made way more money than you actually did. And this slide just illustrates that problem of churn perfectly. I mean, imagine this. A player deposits $1,000. They bet that money over and over, maybe 10 times, so they've churned $10,000 in total bets. And at the end of it all, they just withdraw their original $1,000. They made zero profit. But because of all that activity, their 1099-K could show thousands of dollars in income, literally creating a tax bill out of thin air. So how do you fix this? Well, the IRS actually provides a very specific 3-step method on Schedule 1 of your Form 1040. First, you have to report that big, incorrect gross amount from your 1099-K on line 8Z. Then, right away, you enter a negative adjustment for that exact same amount on line 24Z, which basically cancels it out. Finally, you report your actual true gambling winnings on line 8B. This is the official way to neutralize that inflated number and only report what's actually taxable. All right, now we're getting to the really painful part, the impact of this new law. OBBA has created this bizarre and punishing situation that we're calling phantom income. It's a scenario where a gambler who just breaks even for the year, no economic profit whatsoever, is now going to owe a significant amount of tax. It's wild. And this right here gets to the heart of how it works. The new law forces you to throw away 10% of your losses before you're even allowed to use them to offset your winnings. It's a mathematical trick, plain and simple, that guarantees you'll have taxable income even if you didn't actually make a single dime. And this table just lays out the real-world cost perfectly. Look at this example of a break-even gambler. Under the old rules, it was simple. $500,000 in winnings, $500,000 in losses, that equals zero taxable income. Makes sense, right? But now, under the new OBBA rules, that same person can only deduct $450,000 of their losses. That's the 90% rule. And bam, just like that, they're left with $50,000 of taxable income. So that $50,000 figure, that's what this is all about. It's not real money. It's phantom income, a tax bill for profit that literally never existed. This is the absolute core of the trap that this new law has set. And this, of course, raises the big, critical question that we're going to answer in the rest of this explainer. If the law itself is what's creating this phantom income, what's the strategy? How can you legally and correctly fight back? So how do you fight this? Well, the main defense is what the source material calls an essential survival mechanism. And it's going to require you to completely change how you think about and how you calculate your winnings and losses from the ground up. This defense is called the session method of accounting, and it's all based on IRS guidance from Notice 2015-21. So instead of counting every single winning bet as income, what this allows you to do is calculate a single net result, either a win or a loss, for a specific period of play, which we call a session. And a session ends when you stop playing a particular game on a particular day. This is why the session method is the absolute key. Let's go back to our break-even scenario. If you use gross reporting, you're forced to report $500,000 of income, which then triggers that nasty phantom income tax. But if you properly apply the session method, the net result of all that activity is zero. You report 0 session wins, 0 session losses, and you end up with 0 taxable income. It directly eliminates the problem before it can even hit your tax form. But, and there is a huge catch here, you can't just say, oh, I use the session method. You have to be able to prove it. And the IRS has a very old, very strict, and absolutely mandatory set of rules for how you do that. It's called Revenue Procedure 7729. Now, what's absolutely essential to understand here is the requirement for a contemporaneous log. That's just a fancy term for a diary that you keep while you're gambling, or at least very close to the time. You can't just collect all your tickets in a shoebox and try to sort it all out at the end of the year. The IRS is explicitly clear that is not good enough. The burden of proof is 100% on you to keep this detailed log in real time. And to be compliant, your log absolutely must contain these 5 specific data points for every single session. You need the date and the type of wager, the name of the casino or sports book, its location or its URL, the amounts you won or lost, and, this is the one that always surprises people, the names of other people who were there with you. It sounds strange, but it's to help verify you were actually there and to deter fraud. And believe me, Revenue Procedure 7729 gets even more specific depending on what you're playing. For slot machines, you need the actual machine number. For table games, you need the table number. Betting on horses, you need the race number and the horse's name. This isn't optional, you know? This level of detail is the required standard to validate your log and prove your session results in an audit. Okay, so now we have the solution. But how does this all actually play out on your tax return? And what happens if you get that dreaded audit notice? Let's put all the pieces together. The filing process itself has its own little trap. You report your total session wins on Schedule 1, which increases your income. Then you deduct your total session losses over on Schedule A. But here's the catch. The losses are an itemized deduction. So if you're someone who takes the standard deduction, you get 0 benefit from your losses. You actually end up paying tax on every single winning session with no offset at all. It's brutal. And finally, you have to expect more audits. Think about it. With this OBBA law creating phantom income, a break-even gambler is suddenly a potential source of tax revenue for the IRS. So auditors are going to be incentivized to attack your records. They'll likely challenge your definition of what a session is, trying to split a break-even session into a winning part and a losing part. And you can bet they'll scrutinize your logbook for any little sign that it wasn't created in real time. You know, stuff like the ink being too consistent, suggesting you filled it out all at once. And that really leaves us with the final critical question. We live in a world of instant digital betting, right? But your ability to comply with the tax code and defend yourself against this phantom income, it depends entirely on your mastery of record-keeping rules that were written back in 1977. Your modern wagers are facing an old-school audit, and the question is, are you prepared?